I comfortably outperformed the market during the accumulation phase of my investing career. And I would love to tell you that I did it with a complicated strategy, something that shows off my investing genius. But that's not what happened. I left the S&P 500 in the dust by investing in two passively managed ETFs, SCHD and VGT. These are my two favorite ETFs, and they couldn't be more different. A simple 50-50 mix of SCHD and VGT is a rare combination that can give your portfolio an advantage in both good and bad market environments. Now, if you've been investing for a while, you might be thinking, Jeff, just dollar cost average into the S&P 500 with something like VOO, and you'll outperform over 90% of the investors over the long run. And that's really good advice. Even the legendary Warren Buffett says that most everyday investors should do exactly that and never look back. Buffett is one of the few people on earth whose advice I'd follow blindly. But in this case, I decided to go rogue. I believe that there had to be a simple and passive way to beat the market. And it turns out, I was right. In this video, we're going to break down this SCHD and VGT mix and show how beating the market, even by a couple percentage points, can compound into massive wealth over time. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. If you enjoy this content, powerbomb that like button, subscribe if you haven't already, and consider joining the channel membership. You know what time it is. Let's grow. The market. Very few investors outperform the S&P 500 over a decade or longer. And like most successful investing strategies, the methodology behind the S&P 500 is about as simple as it gets. It holds 500 of the largest companies in the United States. When you buy a single ETF that tracks the index, you instantly own a small slice of all 500 businesses. And my favorite ETF for this is from Vanguard, and its ticker symbol VOO, commonly referred to as VOO. VOO does all this work for you for a mere 3 basis points of an expense ratio. This means you only pay $3 per year for every $10,000 invested. It basically rounds down to being free. And the S&P 500 isn't static. There is work being done here. Roughly 20 companies are replaced each year as the old names fade and new winners rise to the top. Picking those winners ahead of time is incredibly hard, but VOO does it for you while you're taking your afternoon nap. And as a side perk, you will absolutely obliterate the performance of most of the so-called experts out there. But I regret to inform you that you will not be outperforming this guy, because VGT plus SCHD wins. I love both of these ETFs, but VGT has always been my favorite. I am truly a tech nerd at heart, and that has nothing to do with whatever the market is doing this year. I simply think technology is going to thrive for decades to come, and VGT is a good way to capitalize on that growth. Over the past 10 years alone, and this is just dumb, I just looked this up in Seeking Alpha, VGT has returned just over 700%. Over that same time frame, VOO is up a little over 320%. And by the way, that's still fantastic. That 320% over 10 years works out to an annualized CAGR of about 15.5% per year, which is significantly higher than the 100-year average of VOO, or the S&P 500, which comes in at just over 10%. So the most common question I get at this point is, why not just go all in on something like VGT and get rich in a hurry? The problem here, as history has shown us time and time again, is that major growth pullbacks are inevitable. And when they happen, VGT is going to drop a lot harder than VOO does. But that's where the other half of this special mix comes into play, SCHD. SCHD plays the role of the stabilizer. When tech is flying, VGT leads the charge. And when the markets get ugly, SCHD helps absorb the damage. In fact, the 50-50 mix has historically held up extremely well in down markets. It's never been outperformed by VOO in a single down year. As an example, VGT was down over 30% in 2022 alone when growth took a major hit, and the 50-50 mix still outperformed VOO, which was down 18% in that year. I'll let you piece the rest of the equation together. And something that's a little less talked about, but it adds to the power of this duo, is the lack of overlap. I'm out here on Fund Overlap, which is a really neat website that you can plug in any two tickers to see how much overlap they have. And you can see here we put in SCHD and VGT, and they only have 3 common holdings of the 101 that SCHD holds for a total of a 3% weighted overlap. The lack of overlap is one of many reasons that these two ETFs complement one another so well. We'll be diving into a 14-year detailed backtest soon in Portfolio Visualizer to show how this 50-50 mix has dominated VOO for a long time now. But before we go there, let's check out what makes these two ETFs powerful on their own. VGT Details. Let's pop over to my screen now to take a look at what makes VGT such a growth monster. I've pulled up VGT, the Vanguard Information Technology ETF, out here in Seeking Alpha, my favorite investing tool for researching stocks and ETFs. I have a pinned comment if you want to try Seeking Alpha Premium for free, and if you like what you see, you can save yourself some money and you can support the channel. And I like to start out on the summary tab. The most important thing here is you can see that VGT has a razor thin, for a growth ETF, 9 basis points of an expense ratio. That was actually reduced sometime last year. It used to be 10 basis points. But Vanguard commonly will drop the expense ratios as they get more and more assets under management over the years. And you can see here that the assets under management, the AUM, is $112.5 billion. So I don't think this thing's going anywhere. And I scroll down to the fund profile. I'll spare you some time and not read you all this, but the main takeaway is that VGT is passively managed as it seeks to track the performance of a specific index that follows technology. In other words, we're not making gut calls here. Next, we're bouncing out to the holdings tab here. And of course, VGT is 100% technology, and the names will be very recognizable. You can see the top 10 holdings here are NVIDIA, Apple, Microsoft, Broadcom, Palantir, AMD, Oracle, Micron, Cisco Systems, and IBM. VGT does have 324 holdings, and the top 10 names that I just read off make up 59% of the fund. And you'll notice that NVIDIA is 17.5% of the fund, and then the other two big ones are Apple at 15 and Microsoft at 12. But just remember, 2 years ago, NVIDIA was only 4% of this, much like Broadcom now. So you really do get the run up. People worry about the top companies having large market caps, but this self-corrects. You automatically adjust per the market real time. Many were worried that Apple and Microsoft were too much of the fund at 43% 2 years ago. And I said no, because if they go down or something else rises up, this encapsulates all of technology. So you're going to get it by market cap. You don't need to worry about the specific winners and losers on run-ups and falls. It's much like the S&P 500 where you just grab the whole basket. You got to profit dearly from NVIDIA, and that's why VGT is up so ridiculously in the last few years, even with some other big names underperforming comparatively. And now, of course, we're working with a growth fund with VGT, so let's pop out to the only tab we really care about long term, and that's the charting tab. Now, I'm starting with a 1-year look back. We're starting small and we're going to expand out. But you can see that both have performed fairly well over the trailing 12 months here as of February 17th, 2026. VGT is up 15% to VOO's 13%. When we zoom out 3 years, VGT is up a staggering 105% to the market's solid 74%. Over 5 years, VOO made a little bit of a comeback. VGT has 99% compared to VOO's 87%. But when we stretch it out 10 years, oh my goodness, VGT is up a whopping 704% to the market's 322%. Again, 322 is fairly eye-popping relative to the last 100 years. 704, yeah, it's been a bull market. That's great on the way up and all, but how do we protect ourselves on the way down? SCHD Details. If VGT is the rocket ship, then SCHD is the seatbelt. Let's check it out. Before jumping out to Seeking Alpha with this one, I want to discuss the methodology of SCHD, because this is what makes it so incredible and so consistent. So from the very top, SCHD excludes REITs, but pulls in all US companies that have paid a dividend for 10 consecutive years. This gets rid of 90% of the companies out there, the ones that haven't, have a high enough market cap and a relatively high trading volume. And after it grabs those stocks from that universe, it scores and ranks them evenly across 4 key categories: free cash flow, dividend yield, return on equity, and the 5-year dividend growth rate. These 4 metrics find quality companies that pay and grow their dividend and have strong balance sheets. It really is a magical mix. Now we're out to Seeking Alpha, where I've pulled up SCHD, the Schwab US Dividend Equity ETF. And the first thing that might pop out is the price. We're down a little today as I record, but SCHD is up to a staggering $31.37 per share. Crossed that $30 per share and never looked back. It's been on fire this year. But we also want to look down, just like we did with VGT, at the expense ratio. And SCHD has a razor thin expense ratio of 6 basis points. Keeps that money in your pocket, and it's up to a whopping $84.42 billion in assets under management. That's impressive. And I won't scroll down to that fund information. We just viewed some methodology, but it is passively managed, and that methodology was of the Dow Jones Dividend 100 Index, which is what it seeks to follow. So much like VGT, no gut decisions here. That's always important for me personally. And now here's where SCHD shines as a counterpart to VGT. You'll notice that technology is nowhere to be found on the top 5 holdings. We start with energy at 21%, consumer defensive at 16%, healthcare at 15%, industrials at 11%, and consumer cyclical at 10%. Now technology comes in under 10%, and to give it its due, it's a very nice 9.69% actually, and that helps it fit so well with VGT, with the tech and generally growth lower and the value higher. And financials rounds it out at 9%. And for the top 10 holdings, I'm not going to read all the names, but you can see clearly much more conservative companies than we had with VGT. And they do have a cap of 4% per holding and 25% per sector. You'll notice they do drift above 4. It rebalances quarterly, and the reconstitution is every year in March. And after the reconstitution, a lot of times the sector breakdown will change, but over time it is proven to be for the better. And there are 103 companies, with the top 10 names making up about 42%. Okay, and I skipped the dividend tab on VGT because, let's be honest, nobody cares about that with growth stocks, well under 1% yield and all that stuff. With SCHD, we're not skipping this tab. We're gonna start here just on the dividend scorecard, and you can see the dividend grade's an A. SCHD starts at a nice yield of 3.31%, but then its growth rates are where it shines. The 3-year dividend CAGR is 7%. The 5-year compound annual growth rate of the dividend is 9%. And then over 10 years, the CAGR is over 10.5%. This is what you would compare to your yearly raise or inflation. And I think 10.6 likely compares favorably to both, unless you're an up-and-coming young gun in your field. So it really helps your purchasing power grow over the years. And recently it hit its 14th year of paying a dividend and 14th consecutive year of growing that dividend. That's right, this fund has never once in history paid less money per share owned than it did the year before. And now we're out here on the charting tab, which, let's be honest, we all know over the last few years have not been as favorable for SCHD. It did beat the market by quite a bit over its first 11 years, and the index dates back to 1999, and it has also outperformed the S&P 500, but the last 3 years have been rough. However, we come out here to year to date, and SCHD is up 15% to the market being flat. Over the last year, it evens out a little. SCHD is up a nice 18% to the market's 13%. Now here's where we cringe a little. Over the last 3 years, SCHD is up 37% to 74%. It's been a growth run for sure, as we saw with VGT. Over the last 5 years, a little more respectable, 68% compared to 87%. And over 10 years, The market has dominated, being half growth, that makes sense, at 322% to SCHD's 250. So we've had a booming bull market, but SCHD is there waiting to support the floor. And we'll get into more of those details later on in the video. So far this sounds great on paper, but show me the money, baby. The 14-year backtest versus VOO. Let's turn it over to Portfolio Visualizer to see how this 50-50 mix has held up over the past 14 years. We're out here on Portfolio Visualizer, my favorite site for backtesting scenarios like this one. You can see for Portfolio 1, I have put in 50% SCHD and 50% VGT. That's the mix. And for Portfolio 2, we just have VOO at 100% right here. And before we hit analyze, let's go to the settings real quick to review this. We're pulling as much data as possible through 2026 year to date, yes. It'll start with 2012 based on SCHD's history. We start with the default $10,000, that's fine. I threw in $1,000 on a monthly basis just to make it fun and get the numbers up there a little, and not crazy. That's realistic for a lot of people. We're rebalancing the mix annually, reinvesting dividends, of course, and we'll display income. Let's hit analyze. All right, and you can see we are indeed pulling from January 1st, 2012 through February 13th, 2026. And we always start out here on the performance summary. You can see our starting balance of 10,000. We put in that 1,000 a month. The ending balance for the mix is a very nice 723,000 compared to the market's lagging 576,000. But you can see the standard deviation is a little higher with the mix, but not absurdly higher at 14.5 to almost 14. The best year is better, the worst year is better. Drawdowns are similar, and we have better risk-adjusted returns. So it makes a pretty quality mix that's very similar on a PE ratio perspective, which is always pretty cool. And just to show that we trend with the market and there's no funny business, you can see when the market goes up, the mix and VOO go up. When the market goes down, the mix and VOO go down. It's not like you're gambling with some weird alternative asset here. You're never going to win huge or lose huge. You just slowly pull away. This is logarithmic. You can see down on the scaling. That's why it doesn't go up much. These numbers amplify quickly. That's what that means. These aren't even increments. But it may be a little easier to see down here on the annual returns. We can see that VOO actually did win the first couple years here. And then the mix reeled off 10 years in a row from 2014 through 2023. And you can see the down years, the mix wins fairly comfortably. And the mix wins again here when the market was down 18%. And this is that one I was talking about earlier. VGT was down 30%, but the mix was down 16.5. So thank you, SCHD. The market's bounced back here with a couple wins. And then of course, so far this year, the market's flat and the mix is up by 6%. So you get a little variance over the years, but they're always relatively close without any wild runaways. It is a good balanced mix. And the trailing returns, this section's fun. So we're just gonna focus on the annualized returns here. And you can see the 50-50 mix is on top and VOO is right below. And for the full duration, for 14 years and change, the magical mix is just a touch below 17% CAGR to the market being a touch below 15%, almost exactly a 2% win, which compounds immensely. We'll see that later. The 10-year returns are 18.5 for the mix to 15.5 for the market. That's incredible, by the way, that 10-year CAGR. The 5-year annualized return is around 15 for both. The market does slightly win. And the 3-year is just astronomical for both. This is ridiculous. 20% compared to 21%. So VOO comes in on top. The 1 year is very close. The mix wins. So you can see the longer we go out, the better the mix does over time. And the full duration is about a 2% win. Now, we're not here for portfolio income, and all of this is assumed reinvested, but just to show how the dividend CAGRs add up, especially for SCHD, you start out with a little more dividends actually from VOO the first couple years. But then as time goes on and that dividend growth plays out, you can see they start to nearly double here from 21 on. And now when we come out to the last full year, 2025, it is comfortably doubling. the market's dividends. So the dividend growth rate really does add up, and these are all qualified for those juicy tax purposes. And then in this section, it just shows some style analysis for the mix. I just want to focus in on the PE ratio. You can see here that it's 27.65, and it gets you 68% large cap, 22% mid, and a nice almost 10% small cap. I really like this mix at a pretty reasonable PE ratio. And down here with VOO, wait, 27.65? Hold on a second. Okay, I scrolled up. That is very random. Usually they're close. They are identical right now on their PE ratio. So they come at a similar value as far as dollar cost averaging into target allocations. That's very strange. I've never seen a perfect tie. But you can see that VOO is 81% large, 18% mid, and basically no small. I think that small cap up above is really what helps them over the years if you know your market history about small versus large over prolonged times. I mean, there's other variables, of course, as well, but I like the mix a little better than VOO when it comes to these metrics. And this is the part where those small wins start to compound into a huge deal over multiple years. The difference compounds. Beating the market by 2% per year doesn't feel like a big deal. It's not going to have your hometown throwing you a parade. But when you stack those small wins year after year, the wealth starts to accumulate, and quickly. Let me show you what I'm talking about. I threw together this simple spreadsheet to show the power of compound. Now you'll notice the mix out here, this is the 50-50 mix, has that total return we just saw in Portfolio Visualizer, and same with VOO. And these are both astronomically high, by the way. Do not expect this in a typical 14 years and change. It's unreal. So we're going to see how beating the historical average of 10% versus VOO's average and then the mix's average plays out here with some scenarios. Now, first of all, starting with $0 to our name and putting in $100 a month. So we're starting zero here, not 10,000. You can see with 0% growth, your contributions only over 30 years, you've put in $360,000. Now, if you assume a 10% growth instead of zero, you end the 30 years with 2.2 million. You hit over a million before 25 years is up here with 1.3. You can see it starts a little slower to ramp up. After 5 years, you only have 77, but then the compound kicks in, well over doubles after 10, doubles after 15, doubles again 15 years in, and you just keep that trend going all the way to 30 years in. You're already at 2.2 million, not too bad. Let's keep these numbers for reference. This is our 10% scenario right here, ending balances. But now we're going to see what happens with VOO's returns. Now, this is interesting because after 5 years, you're not that far ahead, only 11,000. It doesn't seem like a big deal, but you can see instead of doubling, they're more tripling or somewhere in there, and you get a little ahead after 10 years, still nothing to write home about. But then you come down 20 years, you're at 1.5 million instead of 750,000. And after 30 years, you're at $6.9 million instead of 2.2. It just seems fake. You're thinking basically 5% extra does that. It really does. That's what's wild. You over triple with 15% instead of 10%. So just that additional 5% per year triples your money. Now let's see what the mix has done. And again, these CAGRs are real to what actually happened over 14 years and change. Now, the numbers are spiky, but when you even out the CAGR math, this is where you end. We see a nice little jump here. Let's just take these numbers right over so we're next to VOO. We're still not that far ahead after 5 years. It takes the compound some time because we're only winning by 2%, remember. 2.02%. But then you start to pull away and you think, wow, for 2%, I'm at 815,000 instead of 665 after 15 years. And then you look at 2 million versus 1.5 million. You would never think 2% would be $500,000 in 20 years. But then after 30 years, ladies and gentlemen, from 6.8 to 11 million. Again, I get it. This feels fake. If you take it out 40 and 50 years, it gets more and more laughable. That little baby 2% win of the mix over VOO added up to over $4 million over 30 years. This compound stuff, you just can't make it up. The mix of SCHD and VGT has been rock solid for over 14 years. And I think the long-term outlook is incredibly strong. And speaking of an incredibly strong community, a huge shout out to my amazing channel members, and particularly my new member, MIPF Mark. Thank you for joining the membership, and welcome to this great community of investors. And to all you OGs, I say it every video, but you really do make this fun, you make it possible, and you're a big part of what keeps me making these videos for YouTube. I appreciate you. Before I get out of here, let me know your favorite combination of 2 ETFs to build massive wealth over the years. Drop it in the comments. And check out one of these 2 videos to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you in the next one. Peace.